People often say cash is king, but here's something most people never see. If your great-grandparents saved a single dollar in 1925 and handed it to you today, that safe choice silently lost about 95% of its buying power. A dollar back then now buys only around 5 cents worth of goods. To match its original buying power, you'd need about $18.50 today. And here's the surprising part. This didn't happen because of a stock market crash or a major crisis. It happened because of a slow, predictable force built directly into the system: inflation. Inflation didn't just make prices rise. Over a century, it changed who built wealth and who quietly fell behind. And once you understand why cash lost value, you can understand which assets won the last 100 years and what that means for the next 100. Keep one number in mind: 18.5. If something increased more than 18.5 times since 1925, it kept its buying power. If it didn't, it lost real value. So let's look at what actually happened. For decades, the US dollar was backed by gold. Under the Bretton Woods system, global currencies were tied to the dollar, and the dollar itself was fixed at $35 per ounce of gold. This fixed link created discipline. Print too many dollars, and foreign governments could demand U.S. gold in exchange. But in 1971, President Nixon ended the gold convertibility of the dollar. Overnight, the dollar became a fiat currency, backed not by gold, but by trust and policy. It didn't feel dramatic at the time, but it opened the door for the money supply to grow faster than real goods and services. More money chasing the same amount of stuff is the foundation of modern inflation. From that moment, savers weren't the winners anymore. Owners were. To beat inflation, you had to hold things that couldn't be printed, assets with real scarcity. Gold is the most obvious example. In 1925, it cost about $20.67 per ounce. Today, it's worth over $4,000, nearly 200 times higher. Gold didn't make people rich quickly. It protected value when paper currency didn't. If someone held $1,000 in cash for a century, it would now buy about $54 of goods. But $1,000 in gold would be worth around $190,000 today. That's the difference scarcity makes. Real estate also outpaced inflation. In 1925, the average Boston area home cost about $6,500. If home prices only kept pace with inflation, that home would cost about $120,000 today. Instead, the median price is around $410,000, more than 60 times higher. You can print money, but you can't print land. Zoning rules, building limits, permitting, and construction costs slowed down the supply of new homes. When supply stays tight while demand increases, prices don't just rise, they accelerate. That's why home ownership became one of the most powerful wealth builders of the last century. But some things didn't rise with inflation. Some actually became cheaper in terms of effort. Cars are one example. In 1925, a Ford Model T cost $260, which equaled about 2 months of income for the average worker. Today, a new car might cost $50,000, about 7 months of income. In raw terms, cars take more of a year's earnings, but modern vehicles are dramatically safer, more advanced, and more reliable, and most people finance them over years. Economists say that, adjusted for financing and quality, car affordability has been relatively stable. Gasoline tells a similar story. It cost about 20 cents per gallon in 1925 and about $3 today, a roughly 15-fold increase, which is actually below inflation. Productivity and global supply chains kept costs lower than they otherwise would have been. Technology is the extreme example. In 1980, storing 1 gigabyte of data cost about $1 million. Today, it costs a couple of dollars or less. That's incredible for consumers, but it also explains why tech devices lose value quickly. They're deflationary goods, great to use, terrible to hold as long-term stores of value. Now let's look at the scoreboard of the last century. General prices rose about 18.5 times. Gold rose around 200 times. Housing rose about 63 times. Average income rose about 15 times. And cash lost 95% of its buying power. The pattern is clear. Wealth flowed toward ownership of scarce resources and productive assets. After the Great Depression, many people trusted cash and bonds as the safest place for their savings. But over long periods, these assets quietly lost purchasing power. Meanwhile, ownership of businesses, stocks, offered built-in protection. Companies can raise prices, innovate, grow profits, and reinvest earnings. For example, $1 invested in Coca-Cola stock in 1925 is worth roughly $4,200 today. That's the compounding effect of productivity and reinvestment. In recent decades, new forces have shaped inflation. Since 2008, central banks have used tools like quantitative easing, creating new money to buy bonds and stabilize markets. After 2020, even more currency entered the system. Some economists now explore modern monetary theory, which argues that governments can fund spending by issuing currency directly. These policies can help during crises, but they risk raising inflation when money creation outpaces real production. This is why many people look for assets that can't be easily replicated: gold, real estate, fine art, or certain digital assets like Bitcoin. These aren't guaranteed winners, but they all share a key trait: limited supply. So what does the past century teach us about the next one? The lesson is simple. Nominal safety, keeping money still, is not the same as real safety, which is keeping its buying power over time. 3 principles stand out. First, holding cash for too long quietly erodes your purchasing power. Even small inflation compounds dramatically. Second, owning productive assets, like businesses or diversified stock funds, has historically offered the strongest long-term protection against inflation. And third, scarcity matters. Assets limited by nature, regulation, or design tend to preserve value when the money supply expands. It's not just how much you save, it's what you save in. Over the last century, $1 quietly became 5 cents, not because of crisis, but because of time. Understanding that story isn't about fear, it's about clarity. Because once you understand how value shifts, you can make better decisions about preserving your own. If this helped you see money differently, let me know which type of asset you believe will stand the test of time over the next 100 years.